Welcome back to Investor Secrets, your exclusive series dedicated to uncovering the insider knowledge behind the decisions tech investors make. I'm Phil Cutting, founder of Line ProDev, and today I'm thrilled to take you behind the scenes in one of the most critical topics for startups and founders: what tech angels are looking for when they invest in early stage companies. And this isn't just about capital, and it's about insights, but it's also about market trends and finding the X factors that set up successful startups and set them apart from the crowd. And today, I'm going to break it down with verified data, real-world examples, and research-based analysis. You'll get everything you need to know to position your app or startup in front of the investors the right way. So stick around, and it's going to be packed with value. To understand what tech angels are looking for, you first need to get into their mindsets. Here are the key traits that drive their decisions. First of all, we look at risk tolerance. Tech angels know what startups are risky, but with high rewards. They're willing to take calculated risks for high potential. The average success rate for startups is 1 in 10 success. They focus on the 10% with exponential growth potential. Often, tech angels will have a passion for innovation. These investors are attracted to disruptive ideas that challenge the norms. They like that drive. They're driven by it. In 2023, 60% of tech innovations focused on AI and machine learning. The market cap for AI-related startups grew by 22% last year. Angels want to see the potential for fast, sustainable growth. Investors often look for projected revenue growth of at least 30% per year. SaaS companies, on average, show growth rates of 40 to 60% in early stage investments. One of the first things investors analyze is the market size and the growth potential of the company that they're interested in. There's going to be a key term. It's called total addressable market, and you'll heard it say is either TAM or TAM. And TAM is a key metric that investors want to know, where it's how large is the attainable market. How much of this market is a market segment that you could possibly take over. Reasonably, right? Nobody expects you to any kind of company to take more than 10 or 20% of a large market. So don't go there and say, yeah, we're going to take over 60, 90% of the market. The global tech market was valued at $5 trillion in 2023, and it's projected to grow by 6% annually, reaching $5.8 trillion by 2027. Markets like AI and blockchain have been grown exponentially with a 35% CAGR. This is compound annual growth rate. You'll hear this term. I use it a lot. It's either pronounced CAGR, kind of like a soft A or a strong A, or often just CAGR. This table here just kind of shows 2023. We're looking at a $5 trillion global market for technology. And with a AI market having 35% CAGR, and blockchain was at 24%. CAGR. Yeah, blockchain had its kind of day as far as really like a lot of growth, but the people are kind of excited about it still because of the way it helps track things. In 2027, the projection is 5.8 trillion with a CAGR for AI at 38%. And blockchain market's going to up to 27%. I think that's largely because of the way that it's starting to be used in retail. And these numbers do matter because the larger the market, the higher the potential for exponential growth. Investors want to know if the market can absorb the growth that your product or service brings. So there's different products that it's easy for you to take over the full market, not the full market, but a large part of the market, but it's not a big enough market. It's not so many millions of users that if they invested in it, they'd see high returns, right? So the growth potential is limited. Now, it doesn't mean those aren't great markets to invest in individually, right? It might be that if you take over a good percentage of this market, that you make it a marvelous living without having to do a lot of work to do that. Just know that investors don't tend to invest in like personal projects. It needs to have a large upside. Investors also want to see how you stack up against competition. They know that innovation can only take you so far if you're facing dominant players. So here's what they're looking for: your unique value proposition, UVP, and investors will ask, what sets this product apart? What is unique about it? What's meaningful about it to the clients? 82% of angel investors say that they are looking for startups with a clear UVP, with a clear unique value proposition. Market leaders often achieve up to 3 times higher returns when their UVP is clear and compelling, and it shows that they've planned through and validated it in many cases, or maybe they're just intuitively on track. But generally, it shows that they've looked at it from the market side. Now, you want to understand how much market share the startup could gain. In SaaS, dominant players often hold 60 to 80% of the marketplace. However, investors are often more interested in startups that are disrupting the status quo, especially when they have target niche markets. So for example, here's just an example, right? A major company A has 60% of the markets. Major company B is at 20%. C has 10%. So that's 70%. And startup Y and startup X are disrupting by coming in at that 5% each, making up another 10% of that leg. So they're potentially looking at step by step, taking over company C, company B. And sometimes it's interesting, company A may buy you out at that point, right, to prevent you from becoming a competitor to them. Or you might even overtake, in year 5, company A, in this case, the major competitor. I wouldn't go in there and say, yeah, we are going to dislocate company A, right? We're going to totally knock them out from 60 to 20%. We're going to take over that 80% of the market, and company B and C are going to become extinct. Now, you may have a case for that, and if you have that case, go for it, right? Go ahead and say what that is, but probably be more conservative on how you present it. Say, hey, we're looking to take over a lot of this lead. Here's these companies' problems, and here's their history, and here's where we're taking over in the innovation. This is why I believe that we can pick up in this case, I wouldn't say 80% of the market, but I might say I believe we can pick up 500,000 clients, or 5 million clients quite quick, because they're all looking for this. So when it comes down to it, numbers are king, and investors want to see solid financial projections and historical performance where possible. So investors are looking for consistent, scalable revenue, and a startup with a revenue growth rate of 50% or more per year, or more likely to attract angel investors. The average startup revenue in 3 years is around $1.5 million. So let that give you a good base to where you stand for how healthy your company is. Now what does that mean, right? That means it's hard to get angel investors pre-capital, before your cash flow and generating cash flow. So keep in mind how to start generating cash flow as quick as possible, because even if you have the perfect product out there, it takes you 2 years to get out there. They still want to see a year, 2 years, 3 years of revenue created. So as soon as you can, get to some kind of revenue model. Angel investors are also concerned with how fast the company is burning through its cash. Healthy burn rate is 10 to 15% of the company's total capital raised. And a startup should have cash runway of at least 18 months to be attractive to angel investors. Below that, yes, you can raise money, but expect to give up more equity, right? The whole goal is to maintain control of your company so that you can share that profits with the people that helped you create that company. If it's your employees, if it's your key stakeholders, or your key family that was there developing it with you. Try to, these are all hints to help get you closer to maintaining control over that and a promising outlook. So for here's what the healthy range, revenue growth rate of 50% plus per year. Current average tech startups are around 42%, and this is the average. Burn rates at 10 to 15%, with the average being around 12%. And cash runway, the optimum is 18 months, a year and a half. The average startup is 15 months. So let's recap what we've covered today. Tech Angels are driven by innovation, scalability, and a high tolerance for risk. They're willing to risk. They're looking for startups with solid market potential, a unique value proposition, and of course, strong financial foundations. Whether you're pitching your startup or evaluating an investment opportunity, these are the critical areas to focus on. Thanks for tuning in, and I hope this breakdown gave you a better understanding of what tech angels are looking for. If you found this helpful, don't miss the next video in our investor series, where we'll dive into the most critical habits of successful entrepreneurs. Make sure to subscribe, hit the like button, and drop a comment below with your thoughts or questions. I'll see you in the next episode.